All right, I believe we are recording, so here we go. Good morning, everyone, and welcome to Kalamazoo Venture Tuesday. Everyone, please mute your microphones when you are not speaking, but do feel free to leave your cameras on. We like to see smiling faces. For those of you who have never joined us before, Kalamazoo Venture Tuesday is an opportunity to see inside the mind of investors as they provide feedback to company presenters. The purpose of KVT is not to secure an immediate investment, but rather it's a teaching opportunity for participating companies and for members of our audience. Each one of our quarterly meetings features a panel of 3 active investors and 3 startup or early stage companies. Each presenter will have 10 minutes to present, followed by 10 minutes of feedback from the investor panel. We will not be taking questions directly from the audience. However, you may ask a question or make a comment in the chat, which is located in the conversation bubble that's at the top of your screen. So we're going to get started first by introducing our esteemed panel of investors. So I'm going to start first with Andrew McColm with Closed Loop Ventures. Andrew, do you want to say hello and say a little bit about yourself? Unmute, wherever you are. There you are.
Hi, thanks, Sandra. Andrew McColm, I'm with Closed Loop Partners. It's a venture fund out of New York. Our primary investment thesis is in clean tech, circular economy. Prior to this, I've worked at both University of Michigan and Michigan State University for a total of 11 years, running their tech incubators, the Art Innovations, and the Venture Center. I've also been with other venture firms in the past, and I've also done over half a dozen startups myself. So I've been basically all the way around the table.
Great. Thank you, Andrew. He and I have gone back a long way, so I appreciate my friends coming back and helping me do these
And by
panels.
the way, I want to shout out to Eli. Hi, Eli. Been a while.
Yep, Eli's here. Hey, Eli. He's been on my panel before, too. Okay, we're going to jump now to Mike Gerfen from Kazoo Angels. Mike, on vacation, thank you so much. Say hello and introduce yourself.
Thank you. Good morning, everybody from Boyne Mountain up in northern Michigan. Mike Gerfen, I owned Biggs Gilmore Communications. We were a digital marketing firm that we sold in the mid-90s. We did a lot, or I'm sorry, the mid-2010s. We did a lot of work in the consumer packaged goods space and all facets of digital marketing for companies like Kellogg's, Kimberly-Clark, and Heinz, and others. After leaving that business, selling that business and leaving that, I joined the Kazoo Angels in 2018. I have a partner that I do that work with, and we have investments now in about 25 companies and 3 funds. I, as of a year and a half ago, took over from Eli Thompson, again, getting a call out on the call as the director of the Kalamazoo Angels. So we've got about 20 active members in Kalamazoo, and we're part of a statewide organization under the Michigan Capital Network Association, where there's about 100 angel investors across the state of Michigan.
Awesome, thank you. And last but certainly not least, my colleague down the hall, Steve Haakenson is with WMU's Biosciences Research and Commercialization Center. Steve, say hi.
Thanks, Sandra. Hi, Steve Haakenson with BRCC. We'll shorten up our name. So we're an early stage life science company located in Western Michigan University. Like Sandra said, just down the hall is my office. We invest in the earliest stage of life sciences, and I'll shout out to Eli as well, because he is one of our companies that he is managing that we invested in. So we invest up to $250,000 initially in companies located in the state of Michigan. We currently have 26 on our books. We've been around since 2004, and I've been with the company with BRCC since 2012, and also have started up 2 companies myself, and previously was at the MEDC supporting their investment in early stage companies as well.
Great, wonderful, thank you. So as you can see, we have a fabulous panel of some really experienced investors who have seen a lot and will be able to give terrific feedback to our presenters today. Speaking of which, we have 3 presenters. They will be presenting in this order. First, we will have Vlad Kravchenko, I hope I pronounced that correctly, with Fieldman. After him, we will have Dan Champeau, hope I said that one correctly as well, from GEKOT Robotics. saying that right? GEKOT or GEKOT? GEKOT. GEKOT. And finally, I can say this one, Peyton Walker is with us from Shuvl. So we do have 3 fabulous panelists or presenters today. So first up, Vlad, we are going to get you started. Go ahead and share your screen and unmute yourself. Okay, get it in presentation mode. Whoops.
1 second. All right, is that working? Do we see Fieldman?
We can see it. It doesn't look like it's in presentation mode, but it's visible enough. So it's large enough. I think we can see that. If everyone is ready, then we've got 10 minutes on the clock and we will start the clock whenever you start speaking. So go ahead and take it away.
Let me start the clock real quick. Hello, my name is Vlad Kravchenko. I am a co-founder and CEO of Fieldman. My experience.
You just muted. Unmute yourself.
Start again. My name is Vlad Kravchenko. I'm a co-founder and CEO of Fieldman. I graduated with computer science degree and been working in IT for the past 20 years. Before I started Fieldman, I worked for a utility vendor for over a decade, where I worked on some large deployment infrastructure improvement projects for Entergy, Duke Energy, Honeywell, and others. So let's talk about infrastructure. What you're looking at is a bridge that fell down in Pittsburgh a couple years ago. And it happened 7 o'clock in the morning while people driving to work. And here's a bus that was actually on the bridge that fell down. We picked this picture because my father-in-law lives a couple of blocks away from that. What's happening here is aging infrastructure. Cities around United States, local governments, have tons of infrastructure that needs maintenance, specifically preventive maintenance. This picture is a little bit dramatic, but there's other infrastructure pieces like pipes, water meters, gas meters, sewer, etc., that requires preventive maintenance. The concept of asset management has been around for a while, but only now is been introduced in local governments, in usually utility and the government behind on software, and this is where we come in. Based on some research that has been conducted recently, there are still 47% of all utility vendors and municipalities in the United States continue to use spreadsheet as a main tool to manage their assets and collect and keep track of the data. This is definitely unacceptable in today's technology-centric world. This is where we come in. We have a product that is a highly configurable and can be adopted to manage just about any type of assets for utility vendors or municipalities. I stress about utility vendors because most of municipalities or utilities do not actually do work themselves. They outsource everything from meter reading to breach restoration. They basically act as a bank. So there's a lot of opportunity there to provide technology for people that actually do the management of the assets and the actual work in the field. A tool consists of 2 major portions. One is the portal, where all the planning and all the integration happens. and the field application where the jobs or preventive maintenance of the jobs or any jobs can be assigned to a particular worker and managed that way. We based our solution on latest technology. We use Azure as a cloud provider. We use our app is progressive web apps. It does not require any installation or app stores, etc. We're trying to make sure that we take care of all of IT needs while the actual worker in the field doesn't have to deal with any of it. Just get a really concentrate on their actual job in the field. Here is our market, niche market that we are going for. Between government tech and utility management asset, we find there is a cross section that looks as underserved currently. We believe that municipalities and utility vendors could benefit greatly from modern tools, tools that we see and use in other areas of our lives daily. So the cross section here is our potential market share. Here's what we're trying to build. We started with a product that we know well, mass media deployment. This is what I've worked previously on many projects. From there, we expanded to work management, to where we can manage not just jobs, but workers and equipment that needed to complete the job. And now we're building the asset management that allows us to expand our footprint within the space greatly. And what we're going for is getting into AI-driven maintenance programs that would produce preventive maintenance based on the actual data collected and predict the next failure and take care of it before it actually happens. So let's talk about our customers. We currently already have 6 customers with 13 and 2 more projects coming online. We have 2 types of customers. Like I mentioned, utility vendors that take care of everything for utility, and they actually usually wear a hat and look and feel just like utility worker. And the actual local governments themselves, like for example, in the city of Statesville, where they use our solution currently to do all of their field work, including meter reading, meter replacement, planning, some pipe replacements, etc. Competition. So what we are offering in our solution is ease of use technology and trying to take away what I call friction, IT friction. Something that I've actually experienced firsthand in the field, where the worker is spending too much time trying to get things to work or set up or install. Instead, they should be concentrating on the actual job that they supposed to work on. Our main competition in the asset management space is Cartograph, CityWorks, Beehive, and those folks concentrate mainly on a legacy solution, and spending. And we're going directly for the cloud solution, software as a service, that allows us to be much more flexible. Here's what we're planning as our growth opportunity. We are currently a 100K plus revenue company. as we roll out our new feature and hire folks for sales effort and spend more money on PR. We believe we can get gross up to 500,000 revenue in 2028. Most of the money we plan to raise is going to be spent on customer acquisition. Customer acquisition is the most important, the hardest part of our business. Everything else is can be done much easier. Customer acquisition is long in our business. Here's our team. I already introduced myself. Anna, also a co-founder, and her main role is marketing. Anna is brilliant at marketing. I highly recommend our LinkedIn series on public works. Anna came up with a very unique way to promote our product through comics based on actual public works that had happened in this country, going back all the way to first sewer in Boston, or unique parks, etc. Dale Newman is a brilliant software developer. Him and I have been working together for many years on actually several different companies. We tend to hire each other when we go to work for somewhere else. So that's been a long friendship, and professionally personally we developed some interesting engines specifically for this product as well, at a highly configurable platform to allow us to basically make solution for any problem out there. Jeremy, also somebody that I worked previously with, very good with customers, extremely pleasant to work with, very helps us to really get the customer on board and keep them happy.
Okay, that's time. Please go ahead and, oh, there we are, wrapping up. Thank you.
All right.
Yep. Oh, go ahead. What else did you want to say? You're on your last slide.
Oh, that's it.
Okay,
I'm open to
perfect.
questions.
Perfect timing. Awesome. Keeping us on track as I always do. We are going to jump right into the feedback session. So we're going to start with Andrew. I'm going to call you out first and ask you to share with Vlad your thoughts and insights.
Okay, just by way of background, I spent 20 years in telecoms, so I have more than a little background in utilities. Okay, a couple of things. One is, and this is, I'm going to be kind of quick and blunt on a few of these things. Your pace is fairly slow. I think you could have probably done that same presentation in 5 minutes rather than 10. I think the high level, I think you hit most of the important things. It was good about sort of, here are the issues, so on and so forth. I think that you could have gotten a little bit more into the detail of day-to-day the collapsed bridge is a great graphic, but why do municipalities have problems maintaining their utilities? I mean, it's true that a lot of their stuff is pretty antiquated and everything else, but also a lot of cities over the last 2, 3, 4 decades have digitized a lot of their stuff. So not everybody's running off spreadsheets and so forth. I think the biggest thing I would say, if you're looking at actually getting an investor to invest in this, is if you're a 100K revenue company right now and you plan to go to 500K, and I assume is that annual revenue or monthly?
Annual. Okay.
If you're going to 500K annual revenue in 5 years, that's probably not going to make their heart go pitter patter. Okay. They'd be looking at something that grows a lot more than that. Now, the reality is that the market you're selling into is the market you're selling into. And I appreciate how hard it is and how long it is to do that. Okay. But I think just from a sort of overall point of view, I think the fact that you've got 100K in revenue is great. You know, revenue is always the sort of, litmus test here. But think about how you could like really scale. And by the way, I didn't hear how much you're raising. I heard that like you're going to be, these are where you're going to be using the money, but what you're looking to raise I didn't hear. Okay. But again, that would be my largest thing is in 5 years, 5x growth is okay, but it's not great. You'd expect to get to at least $1 million in annual recurring revenue. That's kind of the cutoff for software companies.
Okay, great. Thank you. Mike, we're going to go to you next. What are your thoughts?
Thank you. Yeah, actually, unlike Andrew, I have absolutely no experience in telecom or infrastructure. So just coming at it from a little bit more from a blind investor standpoint, I think there were some good points in the presentation for sure. You explained what the issue was. You talked about partners in terms of development on the software that you're using to help make that easy from a user standpoint. You outlined the market very well in terms of what the intersection is and where you fit within that. Some of the points that I would emphasize, some of which are I think reflective of Andrew's comments. One is the bridge is a good example for decaying infrastructure, but it's not as relevant to your product and presentation as I think it could be. And I actually think it sort of took you a little bit off stride transitioning from that into your story. So I would just really, really encourage you to have those first 2 or 3 slides really nailed, really tight, and be able to articulate the value proposition and the problem very, very succinctly during that time in the presentation. From me, from someone who's not someone familiar with the market that you're dealing with, I would have liked to have seen a little bit more painting the picture of really what your software does to help make their operations smoother. I understand it's a utility and asset management system, but really, how does it work? What is the magic sauce that's going to make this very appealing to the utilities that are out there? And then it's great that you have revenue. Like every company that we see that has revenue is a big plus. Doesn't matter if it's $100,000 or $500,000. But I agree the growth rate especially for a SaaS company should be more significant than that. And I'd also like to see some of the depth behind that. How many customers is that? What's the revenue model that's attached to that? You've got 10 minutes, so you can't maybe accomplish all of it, but those would be some of the points I would raise as well.
Thank you.
Awesome. Thank you, Mike. And Steve, please share your thoughts with us.
Absolutely. Being third, the other 2 have hit some of the points that I was thinking about as well. I as well do not have a background in the infrastructure area. And I thought you did a very good presentation, just giving me a high level of what the problem is and what the need is. So I appreciate that. I think from an investor point of view, and I'll reemphasize some of the other panel or other comments that were made. The ask, I'm not exactly sure the dollar amount. I don't think I saw that or heard that. And then the other big focus as an investor, what's our return? So we're thinking as an investor, what's the exit strategy? What the time frame is, what the dollar estimation amount will be on our return. So that's what we're thinking about. So you got to have something in there that gives us some comfort level of an expectation of what you're thinking and what the investors may expect from the return. So I'll agree. The revenue is not as attractive as most investments from an outside institutional investor coming in. We'd like to see a higher revenue or on a company such as yours. The cost savings to your customers. I didn't quite understand what the value proposition is for them. So that would be helpful if you had some information on that in there. And then the differentiator. You touched on the competition. But what's your main differentiator? What's the barrier to entry for anybody else coming in and just doing the same thing you're doing? I'd like to see a little bit more on that. So that's the perspective from somebody that doesn't know the industry, but as an investor, I think those are the points we'd like to see.
Excellent. Thank you. Vlad and your partner, Anna, do you have any questions for the panel? Is there anything in particular that you were looking for some feedback on?
Well, I would say, going back to money, what is, you mentioned million is sort of the entry level, right? At the investment from the revenue point of view, from yearly revenue. So again, I'm very conservative. I like to state something that I can actually hit, right? So obviously, that's something that I can definitely hit. That's what I put in the presentation. So going out there is million is basically the entry level for any fundraising from the revenue point of view as a goal.
Well, it has to do with like who you're actually going after in terms of fundraising. Venture capital is not a monolithic sort of thing. There's different funds will invest at different stages and so on and so forth. So if you're, for software, if you're the below $1 million annual recurring revenue sort of stage, you're in kind of one group of investment sources like VCs or angels and that sort of thing. If you're above the $1 million mark, and this is trailing run rate, okay? If you're above the $1 million, then you get into kind of a different group of VCs, okay? And it's just like if you talk to the people that invest in software like SaaS software and these sorts of things, you'll find a group that says basically like if the company doesn't have $1 million annual run rate or at least very short-term visibility to that, we're not interested. It's below our threshold. Okay. So it's kind of like how the VC world sort of self-segregates themselves.
Okay. Thank you.
Okay. Wonderful. Thank you. It was an awesome presentation. Now we're going to get ready for our second awesome presentation. We are going to tee up Dan. And so, Dan, you can unmute and you can share your screen. Looking good. And whenever you are ready, you may begin.
Thank you. All right, my screen shares up.
Mhm.
So hi there, my name's Dan, GEKOT Robotics. And of course, the question you're all dying to ask is what the heck does GEKOT mean, right? So I was inspired by this first robotics team that I coached, the Great Engineering Kids of Tomorrow, GEKOT. These middle school students were challenged to propose a solution to a real world problem. The kids learned about accidents related to electric scooters. So they designed a collision avoidance system like you do in middle school, right? The team built a concept demonstrator with a kick scooter and a robot controller. And then the team reached out to the world's largest scooter company for feedback on their idea. And they were surprised to learn that such a solution could address a very real industry concern. So you might be aware that Razor USA is that industry leader in kick scooters and electric scooters. Razor has since become our key partner, providing resources to patent and develop our solution. Why? Because Razor expects that such solutions might soon be mandated across their industry, starting with rental scooter fleets. Now, you're likely familiar with these rental electric scooters that are found in nearly every major city. You're also likely to know someone who wiped out on one of these vehicles or tripped over one, blocking the sidewalk. The fact is that there's been more than 100,000 injuries related to these vehicles and too many fatalities. And more often than not, these problems are caused by riders that disregard the safety rules that are set by the host cities. So as such, municipalities are now requiring that these scooters have very specific safety features before they'll grant an operating permit to those rental fleet operators. Now, certainly these companies are thinking beyond just lost opportunities or financial impacts as more cities add stricter regulations. These companies know that they must adopt the safety technology like ours to continue their very core business activities. So GEKOT Robotics serves these rental fleet operators by allowing them to operate in most municipalities. With our added technology, those customers promote safer vehicles, have fewer losses, and receive data for liability concerns. But most importantly, they have that competitive advantage when they approach those markets that require such solutions. In fact, we lived through a real world example of this. As a response to complaints of sidewalk clutter, last year, Sacramento, California passed an ordinance that deployed shared scooters must be tethered to a parking rack with an electronically controlled lock. Now, Razor's shared scooter fleet there was not compliant, and their operating permit was canceled. They had to suspend operations. Well, GEKOT developed a solution that was fully integrated right into Razor's backend software. We delivered 300 locks, and Razor was able to re-enter that lost market. So the lesson we took from here is that the best customer is the one who's mandated to buy your product, right? So our 3 compliance products enable fleet operators to expand their market share. Our parking ordinances are addressed with that IoT-enabled electronic cable lock. Our second product, Ride Guard, utilizes sensors and alerts to discourage reckless behaviors and riding on sidewalks, while also providing vehicle usage data. Our third product, Ride Safe, is a solution set inspired by automotive active safety systems. Here, sensors are used to detect potential hazards, then audio and visual alerts to amplify until the rider takes evasive action. New rules are sure to follow, and GEKOT Robotics is well positioned ahead of potential regulations with an early patent on these solutions. So RideSafe works by using a LiDAR to detect potential hazards. The system determines distance, approach velocity, and time to collision, and then produces alerts for the rider to take action. Now, GEKOT Robotics uniquely provides our solutions without the use of invasive cameras. That's important. These are a frequent target of vandals due to public privacy concerns, and a lot of our competitors are using this technology. We believe that social acceptance of new technology is critically important for public adoption of this transportation mode. Our TetherLock product completed a 1-year pilot, ready for commercialization. That RideGuard product is currently in a 100-vehicle pilot funded by the Michigan Economic Development Corporation. Thank you. RideSafe is currently in an MVP stage and will soon be rolled into that same pilot study. And our development efforts continue with our university partners. Those efforts focus on retail versions for personal electric scooters and personal e-bikes. Certainly, the data collected by our system is of high value, and we'll soon be developing tools to monetize that data. And then we also have a next generation pedestrian detection system in development utilizing millimeter wave radar technology, which is way less expensive and even more capable than what we're doing now. And we believe this product has real disrupting potential. 3 other tech providers are developing compliance solution products, and 6 fleet operators have developed their own solutions internally. In addition to being the lowest priced hardware set, our comprehensive solutions address many problems that our competitors are missing. That said, our unique value extends beyond just pricing. As a whole, our comprehensive solutions outperforms the few competitors out there in terms of safety, anti-theft, liability matters, market share capture, and regulatory compliance, all without invasive technology. We currently market to fleet operators in North America where those tight regulations drive sales. That segment alone is a $43 million market. Now, most of our US customers also operate in Europe, which makes for a straightforward expansion, right? But certainly the largest market is in Asia, which we reach with our partners. Inexpensive battery technology is spurring tremendous growth in this industry. GEKOT Robotics sells hardware at enterprise to the customer specific configurations, right? So once the upfitted vehicles are deployed, we maintain the system via over-the-air updates. We profit from units sold plus system subscription fees, both at margin. So for example, a customer looking to deploy a small 300 vehicle fleet might purchase 300 of our RideGuard units at $150 each. After delivery, we'll invoice a SaaS of $3 per scooter per month. Now, eventually, we hope to add that data analysis as an optional service, right? GEKOT sales channels includes operators, partners, and vehicle makers. We develop our sales channels by leveraging our industry partner network and targeting those markets which mandate the use of safety technology. GEKOT Robotics already has that solid partnership with Razor, as well as Edge Labs in Flint, which is currently building a vehicle integrated with our technology. $350,000 has been raised in non-diluted funds through partners and grants. Razor has been our key strategic partner supporting development and pilots. Here you see the many partners and organizations that have been supporting our R&D efforts through funding and direct services. I'm happy to report that we have now successfully transcended that dreaded valley of death with no loss in equity, of issued patent, and multiple MVPs. The key enablers being our university collaborations and strong partners. So now we turn from building a product to selling a product, right? We'll leverage our current pilots to launch a marketing campaign in parallel. Goals for the remainder of this year include first product sales, 2 new patent applications, and development of additional features. A detailed financial model represents a 5-year plan for aggressive growth and 10% market capture. With appropriate resources applied, we achieve $1 million in sales revenue next year. I'm the founder of GEKOT Robotics with 30 years of control systems experience, launching my second startup. Jeremy there has 10 years in this industry with a previous startup, and this amazing team includes extensive experience with embedded software, machine learning, and light electric vehicles. And then we recently added a professional CEO coach to complement my skills. In addition, key industry advisors share market intel and product guidance. For example, I have a weekly stand-up with the head of Razor's software team. In the near-term milestone is the commercial launch of the product line, right? In parallel, we continue to develop new features with our university partners, and we know that growing the team will accelerate these R&D efforts, right? So IP needs include obtaining freedom to operate with our patented active safety tech and 2 new patent applications for other products. $500,000 is desired for a 12-month runway, after which a second round of $1 million will be sought. Here's some recent and relevant examples where tech companies like ours were purchased by large players in the micromobility industry, which has only been around for 7 years, mind you. It's clear that the top names are either developing solutions themselves or acquiring organizations with proven tech. We've identified many high-profile companies that will likely seek acquisition to stay competitive. One last point. Currently, the US West Coast is the forefront for light electric vehicle innovation. Of course, we know that Michigan is the center of excellence in mobility and that our automotive OEMs are already expanding into this new segment. GEKOT Robotics is working to bridge these industries through local development and manufacturing. My team is committed to reducing accidents as well as promoting the use of small vehicles for small trips, and we invite like-minded persons to come along for the ride. What questions can I answer?
Wonderful, thank you. Right on time. And we are going to head to our panel for some feedback, and we are going to start this time with Mike. I'm going to let you lead off. What would you like to share with Dan?
Unlike not having any experience in utilities, I do have experience on my daughter's Razor, and it's not something I should ever do again. So I definitely recognize the needs that you're talking about here. If I had a checklist, which I don't in front of me, of things I wanted to hear in a presentation, I think I would have checked all the boxes. You talked about, the very well set up the problem, the solution. You talked about the market. You showed us your intellectual property at a high level. You gave us financials with how they're arrived at and what the revenue model looks like. You're obviously very polished in terms of the presentation and your comfort level with the material. And also you're obviously comfortable talking about the world of startup financing when you're talking about the valley of death and understanding what that is and addressing that you have a plan around it or you've made your way through it. Those are all things that make me as an investor feel very comfortable and confident in you as a founder. So I would just say really, really great job.
Thanks, buddy.
Great, thank you. Steve, we're going to go to you next.
Great job, Dan. I agree with Mike that you hit almost all the areas that I'd be looking for. Loved your story at the beginning. It pulled me in as to what the need is and then what you have to offer. Great to see that you've got partners out there already, and that it's multiple products. I mean, even though it's one product, one focus, you got multiple products that you're focusing on, future ones, even expanding beyond the scooters into other areas. So that's great to see from an investor's point of view. I will disagree that you made it through the valley of death. I think you still got to get through that. That's the way I look at the valley of death. You've got some work to get through it. But again, stating that you that you understand it and what's going on there, that as from an investor point of view, that gives me some confidence in what you're doing. So you know, the non-dilutive funding that you received is fantastic to see. As an investor, we'd like to see that you utilize what's out there, what's available, that does not dilute other investors or yourself as a founder. That shows intelligence in that area. So in the exit, I'm really glad to see that you have looked at what possible exit and scenarios are out there and what comps are out there. So overall, great presentation. I enjoyed it. Thank you.
Great, thank you. And Andrew, we're going to let you bring up the rear, share your thoughts. Andrew, I think you're still muted.
Sorry, yeah, I'm the technology guy. Yeah, Dan, I'd just like to reiterate, you know, that was a great presentation. It did cover, you know, basically all the check marks. I would agree with Steve that you're a long way from being over the valley of death yet. You know, but just a couple of comments. One thing that you may want to think about when you talk about the need for the product being driven by regulatory, that scares some people in the investment community. You might want to sort of also say, you know, in addition to the initial driver being regulatory, these are the things that are going to drive, you know, product adoption going forward. Because if, you know, regulations change, right? And they're not necessarily ubiquitous, and they're very, very much from jurisdiction to jurisdiction. Certainly, you said that you're going to be selling into, you know, Southeast Asia and that sort of thing. Trust me, they don't care about helmet laws. They don't care about, you know, like the regulatory regime there is extremely different. So you need to have a compelling story beyond, you know, the cities are mandating this. Okay. I mean, it's great for early adoption, but to get really deep adoption, it has to be more than that. Okay.
Yeah.
And just a quick comment. Did I hear you say you were going to do 500,000 now and then 10 million on your next round?
That's the no 1 million on the next round.
Oh, 1 million. Sorry.
Did I misspoke? Yeah. That would have been
Okay.
a major flip up.
I forget. Thanks for asking. I couldn't hear the number, so that's a good question too. And if it's 1 million, that's a lot easier leap than.
Yeah. Okay. Typically the way to look at these things is look at your cash flow out for the next like 3 years, right? Anything beyond like 2 years is fantasy anyway. But what you should be funding for is 18 months of runway at a minimum. Okay. So that's kind of the bite that most people are looking for, is saying, what are your cash needs for the next 18 months? Because any sort of projections beyond 18 months are ridiculous anyway. But, you know, we want to make sure that you survive 18 months and then, you know, it will iterate from there, is kind of the way most funding goes.
Excellent. That's really good feedback.
Okay, great. Dan, did you have any specific questions for the panel? Was there anything
I do.
that you?
So
Go
I
ahead.
did a little experiment with you guys today. Because I've been pitching to quite a few people, and there's been a bit of a hoopla over what do you guys want to see as when we talk about competitive analysis. Do you want to see something like this, which talks about how my product compares to competing products? Or do you want to see something like this that talks about how my value proposition compares to other companies' value propositions? I've done one or the other in the past, and today I did both. And I'm curious, it's interesting that none of you commented on either of these slides, but I'm curious just what value you see in either of those slides.
Well, if I could lead off, first of all, I mean, they're nice eye candy, but, and sorry for being very blunt, but they're nice eye candy, but the important thing is it says two things. One is you actually know that you have competitors and that you've spent some time looking at them. Okay. By the way, you might add Garmin to that as well. Garmin makes some, you know, products in a similar sort of vein. You know, any decent investor is going to do their own due diligence on the competitive landscape anyway. They're not going to take what you tell them at face value.
Yeah, I'd say the same. Sorry, Andy. I'd say the same thing. It's good that you've got this, that you're showing that you've done your research. We'll be doing our own on that. So, and then when people put these graphs up and show that you hit all the hot spots and you've got the best, that doesn't necessarily mean that that's the case. So it's like Andy said, it's just good to see that you've done some research and you know who is out there, and then we'll see if there's any major ones that you've missed. So that's all that gives us as an investor, or at least for myself, speaking for myself. Good to see, but it doesn't hold a lot of influence on my decision.
Good point.
I would agree. And my only advice in terms of presenting it, if you're going to do it, is, this one is typical. What you're showing now is, I think, more typical of what we see. I would make sure that you're making the transition to the next slide, that, this is looking more from your perspective against your competitors. The next slide is more your customer and the value proposition, the result of that for the customers. I think just making the point a little clearer, because I got a little confused as to what the difference between the two was until you went back and showed us.
Okay. Excellent. Thanks for that feedback.
And if you could,
I connect. Oh, yep. Go ahead.
You go to the previous slide as well. The thing about this one that I liked about it was it focuses on specific features, because the devil is always in the details. And one thing that I think you did a good job of that some people gloss over is like, what are the actual value points? Like what are the features of this that make it important to people?
Excellent. Okay. Well, for those keeping score at home, it's about 50-50 split over which screen, which tab they like. I've connected with reached out with all you guys on LinkedIn. Feel free to connect if you want to learn more.
Okay.
Great.
Thank you. Good job.
Great. Before we move on, we do have 1 minute left in the Q&A time, and there is one question in the chat, so I'm going to go ahead and bring it up. John has asked, can you show a reduction in accidents with the adoption of your technology?
That's it. That's the $1 million question, literally the $1 million question. So the pilot we're doing right now is to answer exactly that question, right? We've got a control group with a data logger, vehicle scooters, and then we got 50 vehicles, and then we got 50 vehicles with our solutions, our mitigating solutions, and we're collecting a ton of data, and we're hoping to answer that question. Ask me again in about 3 months.
Great answer. Thank you. Okay. And we are chugging right along. We have one more exciting presentation. So, yep, you can unshare yours, and we are heading now to Peyton. And Peyton, you can unmute yourself and bring your slide deck up.
Perfect. Hello, everyone.
Hi.
Is that visible?
It is visible. I have the timer ready. You can begin whenever you're set.
All right. Hello, everyone. My name is Peyton Walker. Today we'll be talking about my business, Shuvl Solutions. So first off, the big problem we found is that 20% of office spaces are vacant. This is due to the growing trend of remote work and automation, and this is leaving a lot of money on the table for landlords. Our solution to this is deploying data centers as anchor tenants. By leveraging low disturbance data center designs, we're able to meet the change in demand for office spaces. We're doing a few different things to accomplish this. First off is landlord partnerships. We're partnering with key landlords to redevelop their unused office space to data centers. We're using modular designs. We have highly customizable layouts made to fit locational needs. Additionally, we're using service distribution. We're using a hub and spoke data center design to streamline service delivery and optimize our costs. In terms of the market, global cloud computing is growing rapidly with a projected compound annual growth rate of 20% over the next 7 years. In terms of the total addressable market, we are going after the annual revenue for Midwest data center infrastructure. That's estimated to be roughly $20 billion for 2023. We've calculated that roughly half of that is compatible with office spaces, so the infrastructure would fit inside an office. And then in terms of idle office space, we estimate that there's $1 billion in unclaimed data center revenues that could be deployed directly to idle office spaces. In terms of the competition, we want to be a flexible data center solution. With that, we have a few key areas we want to excel in. First off is repurposing idle real estate. Next would be locational adaptability. Since we're putting data centers in offices, we need to react to our environment. So whether the systems have to be quieter, produce less heat, etc. And then additionally, we're focusing on a part private data center, part co-location setup. And with that, we're going to have a lower CapEx demand. By doing that, it will incentivize landlords to partner with us. In terms of our business model, for every 2,500 square foot data center that we convert, we expect $100,000 in build-out allowance from the landlord. On top of that, once we grow the data center to 70% capacity, and that is active co-location spaces, we would have $900,000 in annual recurring revenue. Those revenues come from the private data center management, the data center co-location management, and hardware sales. Additionally, we expect to make money through software roll-ups. On average, 82% of co-location hardware is idle. So there are systems sitting there paying the co-location company, but the systems aren't actually active. We plan to connect software businesses with high idle rates and have them utilize similar hardware. In terms of traction, we launched our first software company, which is Shuvl Incorporated. This is a crypto mining company that has a management contract with Shuvl Solutions. We grew that company to over $60,000 in hardware under management, and it is currently generating roughly $20,000 in ARR. So what's next for us? The first big step is developing the 2,500 square foot data center and moving our mining hardware over. Also, we would like to start acquiring the data center tenants to grow towards that 70% occupancy rate. Additionally, we'd like to create those strategic software business partnerships and expand our current software businesses. So the team that's going to do it, my name's Peyton Walker. I'm a WMU finance graduate and the founder of Shuvl. I'm responsible for growth, finance, and customer acquisition. I'm working alongside Nate Allwine, who's a mechanical and aerospace engineering PhD at WMU. He's responsible for data center development and software rollups. And then finally, Jack Madsen, who's a Kettering University engineering graduate with 4 years of network security experience. He's responsible for data center operations, software business operations, and network security. So in terms of the projections, in the first year, we'd like to grow up to that 2,500 square feet managed. Prior to the first year, we're going to have 6 months of development where we're focused on growing to the 70% occupancy. With that, we would have a $975,000 revenue at a roughly 15% margin. By year 2, we want to grow to 7,500 square feet of converted office space. That would have a $2.9 million revenue at a more efficient 25% margin. Finally, in the third year, we'd like to grow to 15,000 square feet under management for a $5.8 million revenue at a 28% margin. So we are looking to raise $500,000, and that will help us reach a few key milestones. First off, by Q4 2024, we'd like to develop and manage the 2,500 square feet. Within that, we'd like to operate 72 server racks at 70% capacity. By Q1 2027, we'd like to operate a total of 15,000 square feet of data center space. And additionally, we'd like to have our data center footprints qualified for the Tier 3 accreditation. The way we're going to be using the funds over the first 3 years is half is going to go towards operations, that's labor, electricity, and maintenance. 20% is going to go towards hardware purchases. 15% is going to go towards compliance, which is legal, accounting, and getting those Tier 3 accreditations. And finally, 15% is going to go towards marketing, which is customer acquisition and growth. Thank you guys so much for listening.
Wonderful. Thank you. I'll get back to my timer here. We are going to kick off the feedback session with Steve this time.
Thanks, Sandra. Peyton, good job. Way to get through that and to the point. One concern I have is I don't have background in the area and understanding of the needs for the space in the crypto mining company. Actually, I did see a presentation that you gave as a student. I'm trying to think, is it a year or a year and a half ago? I think it was with the SBDC. And it wasn't focused as much on the office space. I think you really fine-tuned this and made this a lot better to understand from an investor point of view. That being said, since I don't know the space that well, I think a couple of questions I'd have initially that might help if you put it in this is the need, the demand. Is this a location type of, when it comes to the data center space that's needed, the market needs and industry needs? So just a high level of what that demand is out there right now and what you're feeling. So when you get into that 15,000 square foot target that you want, is that in a specific geographical location or an industry location? So again, excuse my lack of understanding of the space, but that's what pops into my head as I'm listening to this. So other than that, I thought it was a good layout, and it seems like you understand and have a good team in place to target this. You seem to have two different revenue areas of the office space and the crypto mining company space, where you've already got some revenue generating there. So that's good to see. So those are my comments.
Awesome, thank you.
Appreciate the presentation. Yep.
Great. Thank you. We are going to go over to Andrew now. Unmute yourself and tell us what you think.
Hey, so Peyton, I think you might have heard earlier that I said I did 20 years in telecoms. Unfortunately, a big chunk of that was actually building data centers. Sorry. So I'm really kind of confused at the end of this presentation about what exactly your business model is and what you're doing, because I heard during the course of the presentation, I heard leasing office space, I heard building and operating data centers, I heard hardware sales, I heard crypto mining, and I don't know which of those you're doing. Plus, there's apparently a bunch of like associated companies and subsidiaries and everything else. And if I was to look at this as an investment, I'd say, okay, what am I investing in? What are the relationships with these other companies? There seem to be a lot of moving parts here. Okay, so I honestly, and I know this area, it's been a number of years since I've worked in it, but I have more than a passing knowledge of it, and I kind of don't understand what you're doing. The other thing is, I would just say that based on my experience of actually building these things, your numbers seem kind of low in terms of what it takes to rehab an office space into a tier 3 data center. Because you've got a lot of ancillary sort of stuff. You've got all your standby, you've got your fire suppression, you've got, you know, your racking systems and everything else. And none of that stuff is cheap. You know, and not to mention the, you know, the interconnects, the redundancy and yada, yada, yada. Okay, so that's just like as a, you know, sort of general thing. I kind of don't understand what I'm investing in here.
That makes sense to me. I think the multiple business part of it can be confusing. I think what I was trying to articulate is that we are working on a kind of co-location business focused on converting the office spaces. Yeah. And the reason I brought up the crypto business was to show that we have the contract that we're already operating for that. Okay,
but that seems to be an associated company.
Okay.
And if I'm investing in the co-location business, an obvious question is, okay, you know, you seem to have one customer who you're related to. What's the relationship there? What's the possibility that they're going to be around 5 or 10 years from now? Because, like, you know, there's a lot of CapEx goes into these things. You want to have at least 15 years to recover that CapEx, particularly, like, obviously the CapEx on servers, you know, that's about a 3-year lifespan on those things. But right. On the infrastructure, you know, racking systems, standby, you know, redundancy, all that other stuff, that should be about a 15-year lifespan.
Do you have any, with your experience, what do you typically think it would cost to build out co-location, just racking and infrastructure?
My numbers are so out of date, they're not relevant.
Right, okay, fair enough.
But I think that stuff's probably just a Google search away.
Yeah, that's what I think as well.
Yeah.
Okay, wonderful. Mike, would you like to share?
Sure. For disclosure, my knowledge and experience in this falls more on the Steve end of the continuum than the Andrew end of the continuum.
It
So
was just bad. It's just bad luck. You happen to have me on this panel.
no,
Good
that's what's
luck.
great. Honestly, it's what's great about these things is you always find somebody who knows something about everything that's being presented. It always happens that way. So, but I would echo a couple of the comments. One is I would also share some of the confusion on exactly what the businesses that I'm investing in. I think, tapping into the obvious and well understood issue of excess office space, I think is great. I would have liked to have heard more about your approach to landlords. Like who are you going to go after? What's your mechanism to get to them, and what is your value proposition to the landlords? Because I could see some landlords being very receptive to this. I could see some landlords being totally not receptive to it, given what their own capital situation and their long-term vision is for their organization, their property. So that would be one thing I think that was missing that I would like to hear more about. And I agree with Andrew's comments about just helping us to understand the various aspects of the business a little bit clearer. Is there a visual that helps do that? Is there articulation of each one that makes that a little bit clearer? And then finally, two more points. One is I would echo, as an investor, I'm always nervous when a related company is providing revenue to the company I'm investing in. I won't say it's a red flag. It's just something that demands a lot more attention from me as an investor to understand really what the relationship and what the risks are between the two companies. And my final point was going to be a really good one. And if I remember it after the Q&A, I'll put it back out there. But overall, those would be my high level comments.
Wonderful.
Great.
Thank you.
Thank you. Peyton, did you come with any particular questions you wanted to ask of the panel? Any specific feedback you're seeking?
I think I got a lot of feedback towards the product, which I was looking for. I think one question that I'd like to ask, so in terms of the connected businesses, the crypto and the data center business, would you say to just drop the crypto business is something I talk about in reference to this, or would you say just further articulate them?
I think if you're going to say you have revenue, you have to say that it's from a related company. I mean, I don't think, so I think you have to make that balance. If you're going to claim you have current revenue,
Right,
and you don't say it's from a related company, as an investor, I'm going to say that's bad faith. I think you just, so it's the decision. Do you want to say you don't have any revenue, or are you able to explain what the relationship is between the two companies? And I'm going to, just my last point I did remember, sorry.
awesome.
It's the financial side as a somewhat capital, not hugely, but a capital intensive business. That's always going to be a higher bar for investors than a low capital SaaS type model business. So you have that burden as one of your presentation points. And getting, I think it was 3 years, you were at a 28% gross margin. Again, echoing an earlier comment, that's not going to make hearts race extremely fast from an investor standpoint. The more that the SaaS side of the business or the software side of the business provides higher margins, the more that can be emphasized, the better off you'll be too.
That makes sense. Okay.
Any other thoughts from the panel? Did you guys want to weigh in on Peyton's question at all?
What he said.
Okay. All right. Well, then we are heading into the home stretch. I just have a few kind of closing comments to wrap us up for today. First of all, I would like to thank all of our presenters for sharing their really innovative companies with us. I just love doing these Kalamazoo Venture Tuesdays and hearing about all the exciting things that are happening in Michigan, and your three are there. Yeah, go ahead and quit sharing your screen there so we're not looking at ourselves double. Yay, there we go. So again, thank you to all of our presenters. And of course, a huge thank you to all of our investor panelists who offered such great feedback, took time out of their day and their vacations. We're very grateful to you for sharing your wisdom and your experience. So thank you for that. And lastly, thank you to everybody in the audience for joining us today. Really hope you'll consider coming back again on October 31st. We're going to have a special Halloween edition of Kalamazoo Venture Tuesday. And as always, that meeting will feature 3 new companies and 3 new investor panelists. You can register for that at our website, which is wmed.edu, and search for the Innovation Center. Again, thank you all for your participation and your attendance. Have a wonderful day. I hope to see you again at the next one, and I'll sign off and say goodbye. Thanks.
Thanks,
Bye.
guys.
Well, thank you.
Sandra.
Great. Thanks, everyone.